In this week's update, the importance of relative strength. Healthcare starts to roar and Bitcoin's still looking very precarious. My name's Garry Davis and as always this is general advice in this video, and please remember to like and subscribe to the video. Alright, another financial year is in the book, and in Australia it was a very positive finish to the financial year. I think we were up something like 25% or thereabouts. The US also finished very well, and in fact the last 2 days of the week, which was the first 2 days of July, the market actually finished very, very strongly, as we'll see. So I just want to cover something today that I cover every now and again because it's really important, particularly in America, probably more so than in Australia, because I think it drives the institutional behaviour more than it does here. Institutions in America are assessed every quarter. They can't afford to lag, and so they're always watching for what is outperforming the S&P 500, and that tends to be a self-fulfilling spiral. So strength demands more strength, and so that directs more of the buying. So it's always important to be aware of what are the strongest sectors, and I just want to touch on that this morning. But look, we want to use as many productive indicators as we can, as long as you don't have so many that it confuses you. But there are a lot of indicators that really are extremely valuable. They include the concept of relative strength, both within sectors and between sectors. Obviously, information about where the money flows are going, the rotational information, what sectors are falling out of favour and what sectors are coming into favour, because that has a tendency to run for quite a few months. Seasonality is a lesser order importance, but nevertheless it does give some support, particularly if all other things line up, to decision making. And of course, last week I covered the dynamics around earnings season, the fact that Wall Street has got a pretty good idea what earnings are going to look like, and we tend to see money flowing into the stocks in the 3 to 4 weeks before earnings are announced, and the bias there is particularly so to the technology sector. And in the last week, we saw terrific outperformance by the tech sector. So they're all indicators that certainly add a lot of value to your analysis. So what's performing right now? Let's look in the last week, so the last 5 trading sessions, and this is in order. XLK, which is technology, followed by healthcare, followed by communication services, and then XLY is consumer discretionary. So that is the pecking order for the last week. So there's been an abrupt change from where we were 2 or 3 months ago. If we look in the last month, it's almost the same. No real change. Just at the end there, they swap places, but that has been the strength over the last month. If we look at the last quarter, you can see it's a bit different. Real estate was at the top of the pecking order. Technology came second, but really only came second because of recent strength. If you go back 3 months and look at what the leaders were then, it wasn't technology. They were right at the bottom. But they've been so strong in the last 2 or 3 weeks that they've elevated themselves to that position across the quarter. But if we go back 6 months to take out of play the strength of the last month, then we see a very different picture. And it was led by energy, financials, and real estate. So you can see there's been a very substantial change in the last month to 6 weeks, and that's very valuable information. It helps you focus on where your emphasis should be in terms of looking for stocks. Now there tends to be, and again these are based on 10 and 20-year averages, so what happens this year could be different from the long-term average, but there is a definite and very significant seasonal bias in July and August towards technology and consumer discretionary on a relative strength basis. Even on an absolute strength basis, so do they go up? A lot of the time they do, but on a relative strength basis, technology and consumer discretionary outperforms the rest of the market the vast majority of the time. So that sort of gives us a bit of an indication that if we want to give ourselves the best odds over the next couple of months, then they're the areas we should be looking at: technology, consumer discretionary. And they're clearly the best performers by a significant margin. All right, before I get into the American stocks, let's just go and look at a couple of charts that are important. I mentioned Bitcoin. Bitcoin is failing to bounce. If you look at this on a very big picture view, this is looking to a fair degree like a big head and shoulders pattern, which don't always break down. But if this does break 30,000, and there isn't much bounce there, you've got to say, then the chances of us having another leg down towards 20,000 is very realistic. But look, I mean, it's so obvious that I just wonder whether it's not going to play out that way, because it really does look screamingly obvious. But if you're a Bitcoin player, then things aren't looking all that rosy at the moment. Now let's just take a look at. I just want to show you this this spread. So this is the spread. This is really another very important indicator. It's the ratio between consumer discretionary and consumer staples. Obviously, when the market is nervous, money flows towards the staples end. When it's feeling bullish, then money will tend to go towards consumer discretionary. So this is the ratio between the two. And what's really interesting is this is the period here. We had a lengthy consolidation where that ratio was stable. So therefore, there really wasn't outperformance by one sector or the other. But that ran from August of 2003 through to the end of 2007. You can see nothing was really outperforming, but we did get a minor breakdown in July of 2006. So there was a preliminary warning sign that things weren't all that great. Now it managed to find another leg up, but then we broke down. So when we broke below this level here, and then also below this little swing low here for absolute confirmation. So that was the first breakdown. That was the second one. That occurred in October 2007. So the market was telling you well in advance that Wall Street was starting to turn defensive in September, October of 2007, because money was flowing preferentially into consumer staples. So this is a very, very, very valuable indicator, and it's why I look at this almost I look at it every day, but I look at this almost every Sunday when I do this video, because it's just such an important ratio. And you can see that it then sold off all the way down into the lows at the end of November. We started to see a recovery. So money started tentatively, after the 2008 crash, money started tentatively flowing back to the more aggressive sectors in early January. Now let's have a look. So from there, we pretty much on an uptrend. We got a consolidation that was occurring pre-COVID. And then when COVID hit, of course, there was a mad rush into defensive sectors, but look, it only lasted a couple of weeks, and then we headed straight back up again. We're in another period of consolidation now, but it's all looking very bullish, you've got to say. And the correlation between the direction of this ratio, so when this ratio is going up, generally the S&P is also going up, and the NASDAQ even more so. So that's where we sit at the moment with that ratio. So it's a very bullish setup for the market. There's the healthcare sector. Last week I said healthcare was one to watch, and we got a breakout, and particularly on Thursday and Friday, very strong. So healthcare now really back performing, and look at the volume. Volume's really picked up into the end of the week. And just to complete the picture, this is technology, which had been running really since about 2/3 of the way through May. So throughout June, we saw a great deal of strength in technology. So that is the setup at the moment for the American markets. And this is this is communication services. So that's another strength area of the market, another aggressive part of the market. Now, to be fair, some of these indices are being buoyed by strength in Google, Amazon, Apple, Microsoft, etc. So this is not quite as broadly based as it would look, and I've got another comment on that in just a slide or two. All right, the S&P gained 1.7 for the week, and what we're getting is a series of quite small and short rolling rotations. You know, we even had a day or so last week where technology, there was profit taking in technology in favour of some money going back into financials, even though that is now not the medium-term trend. But these rolling rotations from sector to sector are actually doing the work of a correction. So a lot of people are wringing their hands, a lot of commentators are wringing their hands and saying the S&P can't keep going up. You know, it's gone too far, too fast. But what they're not seeing is that these rolling rotations are bringing individual stocks back. You're getting that 2 steps forward, 1 step back sort of process that just prevents the market from getting too frothy. So, you know, I don't think the S&P, if you just look at that, I don't think it's as extended as what a lot of people are making out, because we've got these rolling rotations. Now, the Nasdaq did better than the S&P. It was up 2.7 for the week, but I do note that there is some narrowing market breadth. There was a good chunk of those gains in the S&P and the Nasdaq were due to those tech majors. But the offsetting that is the aggressive sectors are leading. You know, that's very, very clear. And we saw that with the discretionary versus staples, and we'll have a look at the other ratio chart in just a minute. The running to earnings is working. As I've been indicating, we're seeing strength in the areas where you'd expect to see good earnings beats. And the dynamics are playing out very nicely. The US dollar was up to 92.23. The 10-year yield fell back to 1.43, and that's obviously helping sentiment towards the aggressive sectors. And the VIX is just barely over 15, so there is certainly no real fear in the market. Okay, let me just check on one of those other spread charts. Just find the one that I want. Yeah, this is the one that I want. This is the Russell 1000 growth versus the Russell 1000 value. And you can see that we had a bit of a breakdown that occurred in March, but we were able to stabilise. And clearly now you can see money is certainly going back, swung out of value stocks, which is, you know, this was started in November or so, and we saw money flowing out of the aggressive sectors going into the reopening, the economic reopening stocks, and back into a lot of stocks that present a fair amount of long-term danger because they're just ripe to be disrupted. Well, that would appear to have played out now, and we're now seeing money preferentially going back into those growth stocks. So everything lines up for a pretty bullish setup at the moment. If we look at the S&P on a daily, you can see very strong finish to the week. The Nasdaq, equally the same, new all-time highs. If we look at the Russell 2000, you can see not quite as buoyant. So we're certainly seeing the impact of those tech majors having on the indices. So it's bullish, but it's not as outrageously bullish as it might seem. And if the tech majors come in with the sort of earnings growth that those price breakouts are indicating, then the rest of the market can just roll on without any issue. Quick look at currencies. This is the US dollar. We ended up down on Friday, but up for the week, and the Australian dollar pretty much reflected that. But we've broken support, we've rallied back, tested that breakdown, and then we started to fall away again. So that's the situation with the Australian dollar. If we look at our market, we were pretty much flat for the week at the overall index level. So just to wrap that one up, the Aussie dollar 74.84 is where we finished, and the S&P was flat. But the laggards last week, as quite different from the American market, healthcare stocks were still experiencing some profit taking, so they were lagging, and energy was lagging as well, and certainly the Australian energy stocks are not doing as well as the American ones. But small caps in Australia really are performing quite well at the moment. Turning to precious metals, gold was up a few dollars, $17.88, but still looking like it, it's just, there's no positive momentum there. So you want to be very careful in the precious metals area at the moment. And I think another $100 down to $16.90 support is certainly still possible. If we look at GDX, it held steady for the week, but there's no leadership from the gold stocks. A healthy situation is where the GDX is going up in advance, quite often goes up 2 or 3 weeks in advance of the underlying metal, and we're not seeing that. So I don't see a basis for a recovery in precious metals just at the moment. Just have a quick look at those charts. So there's precious metal, there's gold on a weekly. It's not disastrous, but it's certainly not looking buoyant. And then on a daily, you can see a bit better day on Friday, but really just consolidation, and there's no real lift there. Silver, just to complete the picture, is really just continuing to grind sideways. GDX, not much happening there. In fact, if anything, GDX is looking a little weaker than gold is. So that's not a great sign for precious metals in the short term. Turning to other commodities, copper was up 429, but nickel was back just a little bit. It was really more about currency moves, and also I think nickel probably had a bit more of a bounce last week than it probably deserved. Crude oil went up to 75.19, so still working its way higher. It doesn't make a lot of sense when there's so much focus on the anti-fossil fuel movement, but it is what it is. There's been less money going into exploration and development, and it's just the supply and demand dynamic at the moment. There's the spot copper chart, not much change. And wrapping it up, my final thoughts, it's important to use all the relevant tools you can. We need as much help as we can get. As long as the tools you're using are all relevant, you know how to interpret them. They're not based on old wives' tales or things that, were part of the market 20 or 30 years ago that just don't apply anymore. Use all the relevant tools that you can, and more than anything, stay open-minded. I get questions from people that are still stuck in the way that they believe things always will be, and the market is just evolving. The economy and society is just evolving so quickly that you've just got to be open-minded to doing things differently to what you may have always done. Portfolio Analyst last week was about using market dynamics to advantage, and I think that was a pretty well received session. And we looked at some more trading opportunities as well, of which there are just so many, it's mind-boggling. So that's it for this week. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.